every day it was like Grand Theft Auto. You're in this like, multiplayer video game and you're just getting bombs dropped on your head every day. The idea is to build a portfolio that has a better Sharpe ratio, that has smaller drawdowns so you can stay invested over time. Stress is a big issue for people. And what causes stress with people? Debt causes stress and risk causes stress. It is pointless to short bonds.
Right.
And this is coming from somebody who was really bearish on bonds and kind of wrong for a long time.
Hi, this is Tony Greer of TG Macro. We are going to interview Jared Dillian for Real Vision. We're going to talk about his early days at Lehman Brothers. We're going to talk about his second professional act as a financial author and journalist. And we are going to talk about global markets. I'm excited to get started. I'm excited to be here with my good friend and inspiration, Jared Dillian. Jared is the editor of the Daily Dirtnap. Jared is a contributor to Malden Economics, Bloomberg, and Forbes. Jared spent 9 years on Wall Street, 2 years at the P-Coast, 7 years at Lehman. He has authored 2 amazing books called Street Freak, is one of them, and the second one is All the Evil of This World. He's an adjunct professor at Coastal Carolina and one of the most knowledgeable people that I know about markets. So let's start digging in, Jared Dillian. Thanks for coming on the show today.
What's up?
It's fantastic to get to do this, isn't it?
Yeah.
So I miss breaking phones. I'm going to be honest with you. That's one of the things that I miss about our days as institutional desk traders. When those scenes being upstairs on the trading desk got hairy, the markets were moving, you had clients picking you off, you were trying to hedge, and all of a sudden one client would pick you off on a monstrous position and you would go to cover it and the market would be gone, and you had every right in the world to go bang and smash that thing right onto the keyboard and have everybody in the room go, what the hell happened to Jared's desk, right? So tell me about some of those days at Lehman.
Yeah, I broke about half a dozen phones. I broke some mouses or mice. I broke tape dispensers.
Nice.
I broke a lot of stuff, threw stuff across the room.
Yep.
I can tell you about the worst day that I had.
Yeah, let's hear it.
And I even remember the date. It was February 27th, 2007. And this was kind of going into the financial crisis. The financial crisis, I would say, started the summer of 07. And basically, we had had a period of time where the S&P was moving 20 basis points a day. Extremely low vol, VIX below 10, nothing going on, just creeping higher every single day, no volatility. And one day we get to work, and China had raised their reserve requirements. Mm-hmm. And if you remember the ABX, the subprime mortgage index, the ABX had cracked. It was down 10 handles. So I get to work in the SPOOs are down 9 points, something like that. Not outrageous, but it was a pretty big move. And I barely sit down and we get this call from an account in London that wants to sell 400,000 EEMs pre-market. And this is before EEM split. So EEM was like $120.
Yeah.
Big trade.
Yep. And
I had just seen this account 3 weeks before I was in London. This is their first trade, so I have to show them a good bid. And I even remember, I think it was EMs were 118 last. I bid them 116, down about 2%. They decorated my bid.
Yep.
And they opened 114 offered.
Yep. That's how that goes.
And keep in mind, this is really before a lot of high frequency trading and a lot of liquidity. It was very hard to get out of that trade.
Yeah.
By the time I got out, they were trading 111. So we had lost a couple $1 million on that trade. The market was down 3 or 4%. We were getting pasted all day long. We had lost $2-3 million. Finally, at the end of the day, I decided I'm going to be the hero and I'm going to try to pick a bottom. And I literally stand up on the floor. I'm like, offer side bid, 2 million spies, call your clients, and I'm making all this noise. Nobody hits me, so I sit down and I buy 3,000 E-minis. And then the trap door opens up and the market drops 20 handles and Globex breaks. Globex shuts down, and the only thing that's trading is the big contract. And the big contract is trading 10 up, 10 handles wide, and I'm long all these deltas and I can't get out. Mark to market, I'm down $5 or $6 million. And I literally sat there and I'm like, I'm going to get fired.
Yeah.
This is the day that I get fired.
Yeah.
And just by a pure miracle, market rips back, ramps into the close. I get out for basically unch. I mean, it was a terrible day, but but that was, even though that was the worst day, that was not atypical of some of the stuff that was going on in that period of time. Every day it was like Grand Theft Auto. You're in this multiplayer video game, and you're just getting bombs dropped on your head every day.
Yeah.
And that's what my life was like for 4 years.
Yep. Yeah, it's very consuming when
Yeah.
you're in that seat, because in order to manage that book, you've got to be thinking about it 24/7. Essentially, there's no out, right? There's no letdown until the weekend comes, and then you're probably still thinking about it because you're so deep in it, right? Those were indeed, I think, the golden age of desk trading. I think we got a couple of good experiences in there before that. Before that seems to be changing quite a bit. So I got to meet you. Probably shortly after that, I think somebody forwarded me on Bloomberg, an infamous Bloomberg that you wrote shortly, I guess, after Ben Bernanke's first rate cut, I believe. And I'm going to read a small passage from that. Buy a ball-peen hammer, buy an air compressor, buy a cheese grater, buy a German Shepherd, buy a racehorse named currency debasement, buy one of those things you shake up and it snows inside. Buy one of those things you push and you make the lines on a baseball field. What was that all about? Can you set that up? Because when I got this email, I wrote back to you and I said, that was amazing, put me on your list, and off we went.
So it was right after the first rate cut, and I had a email list at the time, a list of people I sent Bloombergs to, and it was pretty popular. I had a couple thousand people on my list.
Yeah.
And it was mostly for entertainment purposes, although there was some content in there too. If you recall what the political climate was like in 2007,
yeah,
we've swung very far left since then economically.
Before Occupy Wall Street.
Yeah, it was way before Occupy Wall Street. But at the beginning of the housing crisis, we were blaming borrowers, believe it or not, but we were blaming borrowers. And we were talking about these deadbeats that weren't paying their mortgages.
I remember.
They took out these giant mortgages and they couldn't pay. Eventually, at the end of the crisis, we were blaming the lender. But in the beginning of the crisis, we were blaming the borrower,
right,
which I think, was not misplaced. So that Bloomberg was a response to that we were bailing out people who had borrowed all this money and were not gonna pay it back. And it sort of tapped into a sense of outrage that people had as to what was going on. And so Fed funds were at about 5.5%, and that was the first rate cut, and they were on their way to zero.
Right.
And really, it was almost like a foreshadowing of what monetary policy was going to be for many, many, many years to come.
Yeah, I agree. I retroactively thought I enjoyed it when I read it, and then when we first started quantitative easing, I thought back at it again, and it was sort of retroactively brilliant to me because, when you're talking about currency debasement, quantitative easing, you were talking about buy everything because we're going to start debasing our currency brutally now. And while it's, hanging in there against the others, the purchasing power is obviously even much weaker than it was 10 years ago. I'm very impressed with the fact that you always make yourself available to help others with finances. It's a very, very tricky topic. People tend to shy away from what they don't quite understand. And I read your article about changing portfolio weighting, right? Away from the 80-20 classic portfolio to 35-65, which is 35% stocks only and 65% bonds. Could you tell me a little bit about that?
Yeah, well, first of all, I've been doing the newsletter and associated things for about 10 or 11 years. And professionally, I love to write. It's fulfilling.
Yeah.
I like helping people make money. But I'm kind of helping people that don't really need help, And I think I got to a point in my career where I wanted to have more of an impact, and I wanted to help people who really, their sophistication level is very low, and I wanted to help them more. So I've been shifting my focus a little bit, not of my main newsletter, the Daily Dirtnap, but other stuff. I've been shifting my focus to personal finance.
Yeah, I noticed.
And I did a piece for the opinion page on Bloomberg, and it was about the optimal portfolio. And it's sort of this conventional wisdom that you're supposed to have an 80-20 or 70-30 portfolio, as a portfolio that has a lot of stocks, because that portfolio returns about 8% a year, and that gets you to a certain number in retirement, and okay. So one of the things I've found is that investors may choose this portfolio that's 80-20 versus with mostly stocks, but they don't actually realize those returns because that is a very volatile portfolio. And it causes suboptimal behavior. For example, during the financial crisis, the S&P 500 was down 57% from 07 to 09. How many people hung on for 57%, dollar cost average the whole way down, stayed long? Like nobody did. People barfed. They absolutely barfed. And you can tell people, you can coach them and say, oh, if the market goes down, just by people, they just can't mentally, they can't deal with a drawdown of that size. And if you have a portfolio that's mostly stocks over a 40 to 50 year period, your earnings career, you are going to experience at least one drawdown of that size. And you only make money if you're compounding, and once you sell, you're no longer compounding. So the idea is to build a portfolio that has a better Sharpe ratio, that has smaller drawdowns, so you can stay invested over time. So there's been I've done a lot of work into this. And the 35-65 portfolio is a portfolio that along the efficient frontier has the highest Sharpe ratio. And you basically, your drawdowns are half the size or less of an 80-20 portfolio. And actually during the financial crisis, you would have only had a drawdown of 24%. Wow. And most people can live through a drawdown of 24%. Here's the interesting thing. This is totally cool. So the 35-65 portfolio, let's modify it a little bit. 35% stocks, 55% bonds, 3% broad commodities, 3% gold, and 4% REITs. So 35, 55, 3, 3, 4.
Okay.
That portfolio gives you almost exactly the return of the 80-20 portfolio and has half the risk.
Is that right?
Has half the risk.
Wow, and you back tested it?
Yes.
Wow.
Over the last 20 years. So you can do a lot of things with portfolio construction other than just naively having a portfolio that's massively loaded up on stocks. And the other thing about it is that stress is a big issue for people. And what causes stress with people? Debt causes stress and risk causes stress.
Yeah.
And the goal of this thing is, like, if you have a portfolio that is going to scare the shit out of you like once every 5 to 10 years, like that's not productive, where you're calling your broker like, get me out, like who needs to live like that?
Yeah.
So basically you're gonna have a lower return, slightly lower return. Right. It means you have to save more.
Yeah.
And that's how you compensate.
Yep. I enjoyed reading that part in the article because I try to force myself to do the same thing, and it's hard, it's hard culturally. Right? We're not programmed to save as Americans. It's a really difficult thing to do, but I think that you're shaking a lot of common sense into people with this idea.
Yeah, and the other thing is that if I say to you, you're going to get an 8% return on your 80-20 portfolio, and you're like, okay, like then I don't need to save as much, because you think this actuarial return of 8% is going to exist for the next 50 years. It might not.
Right.
Stocks might return less.
Right.
Bonds might return more.
Yeah. Yep. No, it's a great idea, and I just like the fact that you really take that gut wrenching out of it.
Yeah.
You really take that out of it. So, I like the idea. Also, along the lines of helping the sort of everyman investor, I know that you're starting a radio show on personal finance, and I'm really interested in listening to it. I'd love to hear just sort of what was the brainchild behind it, and when is it going to get going, and what are your sort of basic thoughts about it?
It's still in development, so I can't say too much. I hope to be on the air in the next couple of months or so. It's going to be syndicated nationally, at some point. We're putting together syndication right now, but it's going to be a show on personal finance. Cool. I'm going to compete with folks like Dave Ramsey and Susie Orman and stuff like that.
Yeah.
I'm not totally getting away from the institutional world. I'm going to have a dual focus, but like I said, this is going to be a focus of mine for the next couple of years, is helping people who really need help. So.
I think it's great. And I think you have a great chance to make an impact with young people and start teaching them.
If you think about the generation that's coming up right now and the financial issues that they're dealing with student debt and stuff like that, like they're
unprepared.
Yeah.
And I think that's why I think that you've got a great opportunity there.
Yeah.
So let's move on and talk about Mr. Market. Q4 2018. The S&P is hemorrhaging from 2,800 down to a low print of 2316, and the Mnuchin call happens. The call out to the 6 banks, Morgan Stanley, Goldman Sachs, Citigroup, JP Morgan, Wells Fargo, and he told the whole world that we had ample liquidity there. What'd you think that was all about?
Well, I think I had the same reaction as everybody at the time, that Mnuchin is causing unnecessary panic. I mean, we had a 20% meltdown in stocks, but it's not the financial crisis. So
Right.
what is the concern? Why are we talking
Right.
about liquidity? I kind of put that away for about a month, and then the Fed started to pivot. Powell has had his speech, and he starts walking back to where we had 4 rate hikes planned for this year. They're gone.
Yep.
And then you had Clarita talking about all these emergency tools like capping rates and negative rates and other stuff. And I started to think, I'm like, maybe Mnuchin's call from Cabo San Lucas was maybe something was actually going on.
Like a distress signal?
Like maybe there was a financial institution that was actually in trouble. I
A
mean,
hedge
not
fund, a bank?
either, but probably not a systemically important financial institution. Probably a small to medium-sized financial institution. But I actually, I mean, if you think about this, what's the more likely possibility that Mnuchin is deaf to market sentiment and is causing panic for no reason, or there was actually a problem?
Something that had to get done.
There was actually a liquidity problem somewhere. And I think that that explains a lot of the behavior out of the Fed since then. I actually think the government, the Treasury, and the Fed, I think they were scared of something that happened in December. Mm-hmm. And I don't have any insight as to what that is, but it explains all their behavior since then.
Yeah, it absolutely does. I mean, for me, the Powell 180, which I call basically an exorcism, was unbelievable to me. I mean, he came into office with his chin up, talking about rate hikes running off the balance sheet. And like you said, in 1 month's time, we wound up talking about pinning rates and the media is talking about another round of QE, et cetera, et cetera. And what's mind-boggling is that the U.S. economy is still doing fine. So clearly, Powell has got another motive beyond the Fed's dual duty, which is price stability and full employment. So now that Powell has gone and done a 180, I feel like they're at tremendous risk if the economy continues to improve, because he's not going to be able to say anything about rate hikes. What do you think is next for him or for the markets, or what do you think the big risk is, or what do you think how should we look at Powell going into the next quarter?
Well, I think that the Fed is succumbed to politics, unfortunately. Mm-hmm. And I can sort of I can take a dump on Powell, and I can say that he had no backbone and he caved in and Trump pushed him around. Yeah. Honestly, if you or I were in the same position, we probably would have done the same thing. To resist the political will of that size and scale is just impossible. But what you're going to hear discussions about among economists is wage growth and the fact that we've had 10 years of expansion, 11 years of expansion, mm-hmm. and middle-class wages have been totally stagnant. So there's going to be a lot of talk about using monetary policy as a tool to increase wage growth. So the Fed is way more dovish than we think. Now, if you think about this, if you go back to when Trump became president, one of the things that I was pounding the table on was that we were going to get the Trump Fed. Mm-hmm. We were going to get a bunch of hawks. And we got Quarles. Yeah. But Goodfriend didn't make it through the nomination process. Right. Clarita is a dove. There's one more seat open, and it's definitely going to be somebody who's a massive dove. Yeah. So the Trump Fed is not that hawkish to begin with. And like I said, they're going to become an instrument of politics. You're going to see people talking about wage growth, and the propensity to cut rates at even tiny blips in the economy is going to be very high. So you could actually see a scenario where we have 1%, 2% growth, stocks are basically or down 5%, and we're cutting rates. I think that's very possible.
Wow. So buy bonds.
Yeah, I mean, we've basically been given a green light, the biggest flashing green light of all time to get long the bond market. So if you think about it, if you're capping yields, and this is, Clarita was talking about a policy that the U.S. had in the 30s and 40s. They capped long bond yields at 2% for I think it was 7, 8, 9 years, something like that. Okay. And they ended that policy in 1946. I believe. Don't quote me on that. Okay. So that's been done before. They can cap the yield curve, and basically what that is, it's a put on bonds the Fed can have a bid at a price, and you can sell to the Fed all day long, and the bond market doesn't go any lower.
Right.
So if the Fed is even contemplating this, if they're talking about it, if they're hinting about it, if it even smells like this could possibly happen, you have no reason at all to be shorting the bond market. It's insane behavior to short the bond market at this point in time. The other thing is we have giant deficits. We have $1.5 trillion deficits. Yeah. So if yields back up to 3.25, 3.5, you think they're going to let the bond market go down anymore? It is pointless to short bonds.
Right.
And this is coming from somebody who was really bearish on bonds and kind of wrong for a long time. So.
Yeah. No, it's interesting. The bond market is going to be, I know that there was a big move today with yields going lower on a sort of weak manufacturing number. We've already seen Mario Draghi do the full dove continuation for the ECB. We're starting to see their bond market rally to a point where we've now got $9 trillion in negative yielding assets. To me, that's the signal.
I think you could see, $9 trillion with negative yielding bonds worldwide, that number is going to go higher. Like if I were to come up with a trade on this, I would say buy calls on green Eurodollars.
Buy gold.
Well, yeah, that too. And the gold trade there's more to it than that, because it's not just monetary policy with gold, but it's MMT, right? It's modern monetary theory. It's 90% income taxes. It's wealth taxes. It's talking about like really protecting your wealth. Yeah. Like this is becoming a discussion again for the first time in a really long time. Yeah. I think back to like 2009, 2010, when QE was getting revved up and people were buying like bullion off of like online dealers and getting it shipped to their houses. Yeah. And there was this whole frenzy of activity around precious metals. Yeah, totally. Like if people start to get agitated again about this, modern monetary theory, 90% income taxes, wealth taxes, this is an environment, there's political risk to gold, and this is an environment that gets people excited about gold. Yeah, so. I totally agree. There were gold coins trading on the street in 2011, when the price was up between 1,800 and 1,900, it became a really, really popular thing. Obviously, the long boat got way overweighted and gold pulled back, but it pulled back to a great level. The other thing with gold is that there's a whole bunch of things lining up at the same time, and I'm sort of perma-bullish on golds, just full disclosure. Yeah. But the supply-demand picture is amazing, right? We're talking about peak gold like we talked about peak oil before. We're just not finding any new gold. There's no more discoveries. There's no more finds. Right. Supply is going down. Demand is going up. The supply-demand, in addition to all the political stuff and monetary policy stuff, the supply-demand picture is good for the first time in a while. Do you suggest miners, bullion, or an ETF? Look, if you really believe that there's political risk, if you are at all scared or frightened about the direction that some of the discourse is taking, AOC and things like that, then you have to think about physical. You have to think about physical. Yeah. For a portion of what you're doing. Yeah. So the miners have in 2011 they were terrible businesses. In 2019 they're much better businesses. Yeah. There's consolidation. The miners have a lot of upside. So, yeah, I suppose they do. I have, I don't allow myself to be either a perma bull or perma bear gold. I like to switch and trade them and feel like which way the market's going. But I tend to stay away from miners because I feel like they're just gold plus financial engineering plus the potential of having an irresponsible manager plus all the other associated risks. So the one thing I'll say about gold, if you go back to our earlier discussion on 35, 55, 3, 3, 4, right? Gold should be a small percentage of everybody's portfolio for diversification purposes. Just for reducing the risk, increasing the Sharpe ratio of your portfolio. So. Gotcha. Do you think Bitcoin ever sees the light of day again? I do, actually. And you and I used to joust about this all the time. You were bullish, I was bearish, and I've been beaten up on Twitter so many times about Bitcoin. I've turned a little bit. And I used to think that Bitcoin was going down into the triple digits. Yeah. I don't think you were 150 bid to cover or something, right? I was, yeah. And I don't believe that anymore. What changed you? What is it? Is it the same as the gold discussion? Yeah. Just wealth preservation. So I think that that discussion is gonna start happening around Bitcoin. I would rather own gold than Bitcoin, but I think Bitcoin is probably done going down.
Yeah.
So
Yeah, it certainly feels like it. And Bitcoin continues to harness some pretty good headlines with the amount of, banks and central banks that are accepting it, et cetera, et cetera. So I feel like there's a real push to make it happen. So I don't know what it means for price, but I do believe that in 5 years that you and I are carrying around a Bitcoin wallet. Maybe it's on a phone or something like that, but I believe that we'll have a chunk of it.
yeah, the technology has a ways to go. Yeah.
So in your newsletter, you mentioned socially responsible investing. And I'd love for you to go a little bit deeper into that for us.
So this is super interesting. So first of all, I'm going to say there's two parts to this idea.
Okay.
And the first part is not my idea. It's somebody else's idea that I'm borrowing. The second part is my idea.
Okay.
So the first part is people have observed for a long time that socially responsible investing has been kind of a disaster. It has underperformed the S&P by a lot for many, many, many years. And people can't figure that out because they say, well, businesses that are ethical and socially responsible and do the right thing, they should outperform over time. But they never do. And people kind of can't figure out why that is. And the guys at AQR actually came up with a theory about this. And what they said was that, let's say you have two portfolio managers. Portfolio manager A can invest in whatever he wants. Can invest in anything, go anywhere. Portfolio manager B has restrictions. He has constraints. He can't invest in tobacco. He can't invest in alcohol. He can't invest in guns. He can't invest in oil.
Gotcha.
Okay. So how can you reasonably expect portfolio manager B to outperform portfolio manager A?
Yeah.
Portfolio manager A can do whatever he wants. Portfolio manager B has restrictions. How can you expect the guy with constraints to outperform the other guy?
Totally.
Now that might happen,
Magically.
but it's hard.
Yeah.
But it's hard. Now if you think about it, the stocks that he can own have to outperform. They must be owned by somebody, and those people must be rewarded with higher returns, which is why the vice stocks, like just say tobacco companies, if you take tobacco companies going back to 1999, I mean, they've massively outperformed the S&P. So basically, what I started to think about was, there you're talking about explicit constraints, okay? Socially responsible investing means I have explicit constraints. I have specific companies that I cannot invest in. What if there are other kinds of constraints, like implicit constraints? And what I mean by that is a stock that is so toxic, so embarrassing, so unwanted that you would never touch it. Because if you had it in your 13F, people would laugh at you. Okay. So like reputational constraints. So a pretty good example is a stock like Snapchat.
Yeah.
Snapchat isn't a vice stock or anything like that, but it's been such a disaster and it's had so many management problems that it's just kind of a joke.
Yeah.
And it got to a point where nobody would touch it and the stock got down to about $4. Have you seen the performance lately? It's done great.
Yeah, it's back
up.
So
So what I started to think about was there were these implicit constraints. And if you think about it, an index fund, by definition, has no constraints.
Right.
And every active manager has constraints. If you're a value manager, you can't invest in growth stocks. If you're a small cap manager, you can't invest in large cap stocks. So most active managers have constraints. And if you think about it, like why, I think that explains a lot of the reason why active managers can't outperform the index, because the index is ultimately unconstrained. If you think about who owns these tobacco stocks, it's index funds.
Let's talk about oil for a minute, okay? I still am pretty bullish in oil. I tend to not fade what Khalid Al-Falih says, and when he says that they are going to be very strict on production cuts, keep production cuts online for 6 to 9 months, et cetera, that is going to tighten up the market. That is going to make the price go higher. So I've been betting on higher oil, sort of with that theme in mind. What are your thoughts on the energy market?
So first of all, I'm going to say that you know a lot more about energy than I do, like 100 times more. But what I started to get interested in this, I've been sort of a bear on energy for a while, and I've started recently to change my mind. And this is very, very long-term stuff. But what I started to think about was, what I didn't realize was how big the climate change idea is.
Yeah.
And the idea that people are really bearish on fossil fuels because they truly believe that they think that we won't be using them in 30 years or even 10 years.
Yeah.
Like people believe that they're going to be obsolete and these energy companies are going to disappear.
Yeah.
I did not understand how pervasive that sentiment was.
Yeah.
And that was super, super interesting to me.
Yeah.
And, you know, regardless of you believe, don't believe in climate change or whatever, I think that that's a very one-sided way to look at the trade. And I would be betting that, you know, our use of fossil fuels are going to extend well beyond 30 years.
Right.
Change just takes a really long time.
Yeah.
And I think the trade is very one-sided. And the other thing is that someone mentioned to me the other day that if you tried to open an energy hedge fund right now, wouldn't happen.
I was going to say you wouldn't raise $1.
You wouldn't raise $1.
Yeah.
Impossible. It's a disaster.
Yep.
And that to me, I think is an indication that we're hovering around a bottom in energy. And if you throw that in with the constraint stuff too, then I think it starts to be pretty compelling. So, you know, this from a guy who's been bearish for the last year, like I'm actually starting to get bullish on a long-term basis.
Yeah, and then if you ask me, when you throw in the fact that Goldman Sachs is officially exiting the commodity business entirely.
I got to tell you, that to me is the ultimate.
Right.
So when I was coming on the street in 1999, I had an informational interview at Merrill Lynch. So this is when Merrill Lynch was in Two World Financial Center, and they had that awesome trading floor that was like multi-level.
Yeah.
So if you ever been on that trading floor,
Yep.
and literally, I was standing there. I was talking to like this money markets guy, and there were these guys up on one of the top levels, and they're packing their shit in boxes, and they're packing their stuff up and leaving. And I said to him, I'm like, who are those guys? And his exact quote was, "Oh, those are the commodities guys. We don't need them anymore."
Oh my God.
That was what he said. We don't need them anymore. That was 1999.
Right, and then we went on a 10-year super cycle. 2 years later it started, right?
Yeah. So I mean, that is the ultimate sentiment indicator. When you start, I mean, investment banks are big dumb organizations.
Yeah.
They fire on the lows. They hire on the highs.
Right.
They trade individual businesses very poorly.
Yeah.
Like it's the ultimate bottom tick in commodities.
Yeah.
You know, and the other thing is that, you know, in the ag space, I mean, it's like, it's death. Like, you know, I went to a presentation a couple months ago, and it had to be the most bearish presentation I've seen in my entire life.
Yeah.
You know, like soybeans are a multi-decade problem, and like, you know,
it's staggering. I just spoke at a commodity roundtable to a group of farmers, and I am amazed that they are able to keep a smile on their face with how much pressure that the trade tariffs have put them under. Because now, you know, China is putting a tariff on our grains, and they're also going around us to buy their grains from Brazil and from Russia. And the poor farmer is sitting there watching the price go through the floor and figure out what the hell he's supposed to do next. And for the most part, the farmers are supportive of Trump. So it's kind of like a catch-22 to me. It's really hard to you know, you feel for those guys because they're rooting for the president at the same time. The president's enacting, you know, tariffs that are absolutely killing their survival. So I don't know, you know, I hate to be short commodities below the cost of production type of thing, you know, and we're almost getting there in the grain markets. But at the same time, I don't know what the catalyst that turns it around and makes them rally though. So it's a little bit difficult to call that bottom. But like you say, I mean, I think that, you know, the symbols like Goldman Sachs, it just reminds me of, you know, when Enron went bust and the oil market took off and natural gas took off, and then Glencore IPO'd, you know, in 2011 with gold at $2,000, you know, and that was the peak of that market. And I just want to say, man, if Goldman Sachs is exiting the business and commodities are going to be able to trade without, you know, the vampire squid wrapped around their throat, I'm hoping that that's going to be a green light go. And I'm trying to invest in quarterly too. So I think that's a trend that we'll keep our eyes close on. So I have another question for you. You have been, you know, you are a doer, and you've been a tremendous motivation to me. If there was no Daily Dirtnap, there would be no Morning Navigator. So I want to thank you for that, because you keep leading the way. But where do you see Jared in 10 years?
Well, you know, I hope the radio show is really successful.
Yeah.
I really enjoy writing. I enjoy writing every day.
Yeah.
I will say that I've been doing it for going back to 2004, so 15 years.
Yeah.
And it's a job.
Yeah, it is.
I enjoy it, but it's definitely a job.
Yeah.
And I'm excited about new challenges and doing different things. I'm not exiting the newsletter business, but I'm really excited about the possibility of doing something totally different. I have another book that I'm working on.
Oh, great.
It'll be a personal finance related book. It'll take a little while, but yeah.
Awesome. Well, all I can tell you is keep doing what you're doing, keep leading the charge with the ferocity and passion that you have, and keep inspiring me to, better myself and be a better newsletter author and think more clearly about markets, because you are a great beacon for me out there, and I appreciate it. Thanks very much for doing the interview, man.
Well, that was an exciting conversation. It was great to hear a lot about Jared's past, about what he's got planned for the future, about his view on the bond put of the Powell Fed, and I think we covered a lot of really interesting ground there. For Real Vision, this is Tony Greer.